Hey everybody, it's that time again. Time for managing an options portfolio. My name is Brent Moores, and I'm joined alongside Mr. Michael Fairborn, who's helping me out in the chat. So as you have questions, feel free to type those in. But today, what do I want to talk about? I want to kind of follow up, in a sense, our discussion from last week. But this week, I want to twist it a little bit. I want to talk about reward and risk with long vertical spreads, look at entering a couple long vertical spreads, and then talk about, well, portfolio management. That's what we do in this class. We do a lot of portfolio management, including, I want to talk about rolling an option. We're going to look to roll a calendar spread and possibly even diagonalize that calendar spread today. So we're going to do that all coming up. But before we do that, let me just mention a couple things. One, you can follow Mike or myself on X at Brent Moores CS, at Mike Fairborn CS are our handles. And also remember, options, which we do talk about in this class, are they do carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research, and the information today for general informational purposes only. It's not a recommendation of a security strategy or chart type. All investing involves loss, including all investing involves risk, including the potential loss of principal there on that. Rolling strategies can entail additional transaction costs, including multiple contract fees. So be aware of that. Paper money application is for educational purposes only, and it does not assign short options early, but that's always a risk with options. You're going to get your short options assigned at any time. Past performance of any security or strategy does not guarantee future results or success. A reminder for those of you who weren't here last week, and I see a lot of names out there that I'm familiar with. Grateful to see you. Grateful for all of you. And for those of you whom don't know, well, welcome. I'm glad to get to know you. And if you're watching on a recording, that's great too. But if you want to see past sessions, you can always check out the playlist on this class. I'll put that playlist in the chat if you're watching live. If you're watching on a recording, that's okay too. Just make sure on that Trader Talks channel, which you're probably on, go to the playlist and you can see past sessions. Last week, we talked about reward and risk on short vertical spreads. This week, I'm going to talk about reward and risk on long vertical spreads. So there you go. But just make sure you're subscribed to that Trader Talks channel so you don't miss future content, not just in this class, but other classes that may be of interest to you. So what I want to talk about to start, though, is on a long vertical spread. Let's just kind of initially talk about what a long vertical spread is. And for that, what I'm going to do here is I'm just going to kind of graphically kind of just show you. Then we'll look at some examples here on this. But in the case of, say, this is going to be applied to both long call verticals and long put verticals. But let me just start with the long call vertical spread. What you're going to do is you're going to buy a lower price call. Okay, so long call, and I'm just, for our purposes here, I'm going to say it's a $50 call. And we're going to sell a higher strike call. Okay, the higher strike call, we'll say for our purposes, is $55. Okay, in this example, we'll look at real life examples shortly. The first question is, where is our max gain and where's our max loss on this? Well, at expiration, of course, it's a moving target because of time value and whatnot, but at expiration, basically 55 or higher represents our max gain on that. Okay, and 50 or lower represents our max loss. And depending on how much it costs us, our break even is going to be in between those two. Okay, so that's how that works. That's the basics of a long call vertical. We're going to buy one lower strike, sell one higher strike. We want it to, our target price, where we want it to go, is 55 or higher in this example. We want it to go to that higher strike or not. But we can control that probability. And we control the probability by where the stock is compared to where the strike price is. So if the current stock is at, say, 48, just doing this example, if the current stock is at 48 and we choose these strike prices, then we need that stock to move quite a bit, don't we? We need that stock to move all the way through the 50 and all the way up to 55 to hit our max gain. So that's going to be a lower probability trade, but it's going to be a higher potential reward trade. Similarly, let's say the stock were at 55 and we choose those strike prices. Well, we're already, to start the trade, we're already where we want it to go for our max gain. So that's going to be a higher probability trade, but we're not going to be rewarded as well for it. Let me just give you one more situation. Let's say we're right in between those two, and the stock's at 52.50, and we choose a strike price, a short call that's about equidistant from the long strike, one above, one below. Okay, so we're right in the middle, smack dab in the middle of those two. What are we going to expect for a reward to risk ratio? Probably something in the order of 50-50. Okay, basically, risking about as much as we potentially stand to gain out of that. Okay, so that's just kind of conceptually what we're looking at. That's true too for long put verticals. Okay, I'll go a little quicker on this one, but let's say we did a long put vertical. Well, long put vertical, we're going to buy a put, we're going to do a long put at a particular strike, we're going to do a short put at a lower strike. And let's say the stock is at, I don't know, $35, okay? Well, if we wanted to do a higher probability type trade, then maybe our strike prices we'd pick would be, we'll say 37.50 and 35. Okay, that would be a higher probability long put vertical. Or if we wanted to do one that's maybe lower probability but a higher potential reward, maybe we pick a $40 long put and a $35 short put. You see how that works there? So we'll look at some examples on that here now. So let me start here though. I'm going to start with maybe a bearish example. I'm going to pull up Colgate-Palmolive. The general trend has been down, so I'm going to assume that trend is going to continue, and that's a big assumption. We don't know that for sure, of course, but I'm going to take more of a bearish stance on this. And so if I'm going to do a trade, remember the stock right now is at about 86.76, and 86.76, and so depending on what strike prices we choose, we can determine that probability here. So question from Lawrence, do you ever consider a long call vertical that is more in the money? You certainly can. If it is in the money, then it is going to be a higher probability trade. One challenge within the money contracts is early expiration. Your odds are higher for early assignment. Your odds are higher for early assignment if they're in the money. So therefore, if you're going to go for that higher probability type trade, very often we'll shift to a short vertical instead of a long vertical there, Lawrence. But you certainly can go in the money a little bit on that. But very often when we're going for those higher probability type trades, you'll notice us use short call verticals or short put verticals on those. So great question. Great question. Okay. Let's go take a look at Colgate. Okay. Stocks right here. I'm assuming this is my assumption on this trade here. Okay. And I may be wrong on this. You know, the general trend has been gone. It kind of gapped down, does this, and then I'm assuming that maybe it's going to go down closer into this range here. Okay. Somewhere in that range. So maybe in the 84, 85 range. So I'm going to pick my strike prices with that in mind. And so with the stock here at 86.76, I'm going to make this a little bit of a lower probability trade perhaps, but a potentially higher reward type trade. So let's look at our options here on this. I'm going to go to Colgate-Palmolive. I'm going to go out about 3 weeks on this. And I'm going to look at puts. We're looking at a long put vertical. Stock's at 86.76. I'm going to look and what if we look to buy this $86 strike and sell, I'll go down to 84. I'm going to hold down my control key on this. Here's my long put vertical, and it's an 86.84. Now let's go with what we said before. We said the stock was at, in this case, we need the stock to move a bunch. Remember, 84 represents our max gain on this long put vertical. 86 represents our max loss at expiration. So we need this to move a ways in order for us to achieve our max gain. Therefore, this is probably going to be a little bit of a lower probability, which we know, but probably a little bit higher, better reward to risk ratio on this trade. Well, let's click on confirm and send and see what we got. Here's confirm and send, max profit 150, max loss 50. So we stand to make quite a bit more money than we stand to lose on that. And so that's great, but the cost is the probabilities aren't quite as good on that. So what I'm going to do here is let me put in, I'm going to up this just a little bit. We'll do 3 contracts here on this. And I'm going to confirm and send this trade. Make sure you read everything right here. And we'll put this in our long verticals bucket there. Put it in, we filled, and we now have a long vertical. Let's do one more example here before we get to trade management, everyone. And I'm going to go to, in this case, we'll look at something maybe a little bit more bullish. I'm going to call Morgan Stanley here a more bullish, more bullish stance. Generally, why? Well, the trend has been going up for the most part. Maybe a little more side, a little more bullish. Potential support level right here. Let's look for a trade that's maybe a little bit more even in terms of our probabilities, and we're probably going to expect a little bit not as quite as good a reward to risk in this case. All right, so now I'm assuming that this support level is going to hold. If you don't think that's going to hold, then you probably wouldn't do this trade, right? Okay, so here's what I'm going to do. I'm going to go to trade Morgan Stanley. I'll stick with about 3 or 4 weeks to go here till expiration. And I have the kind of the luxury of a lot of strike prices here. This every dollar, there's a strike price. The stock's about roughly 136. So I'm going to do a long call vertical. I'm going to buy the 132. I'm going to click on the ask price there. I'm going to sell the 140. I'm going to control click there. There's my my strikes, my spread. My max gain would be seen at expiration at the 140 level. We're a little bit closer to that than we are to our max loss area at expiration, which is 132. So what are we going to expect to see on a reward to risk? Well, it's not going to be nearly as good as that last reward to risk, I'm confident, here on this. Let's see what we got. We've got a long vertical, max profit 337, max loss 463. We stand to lose more than we stand to gain on that. All right, so there we go. Again, I'm going to put this in our long verticals bucket there, and I'm going to send that trade. And now we have a couple long verticals in the mix here on this. Hopefully this this cooperates for us. Now we can, well, let's start look at some trades here. Okay. I think the worst trade, or the trade that's going against us the most here on this. And if you have any questions, feel free to ask those questions in the chat between Mike and myself. We'll do our best to help you out on that. Okay. The worst trade we got going right now is this CRM trade. Let me just shrink this down here. Here's CRM Salesforce. We are losing money on this. That's not good. Let's see what we've got. I don't have any exits in place. Now, one thing about spreads is the reason you do a spread in the first place, rather than just doing, say, a short put, is it can help limit the risk for you on that. We still may put in stop orders on that. Okay. We still may put in stop orders on this, but it is a, it's a risk that, but by putting in the spread, we are limiting the loss on this. Our loss on this is about $280 right now on this. So obviously things aren't going very well. Let's take a look at this trade. Our goal was for this stock to be above the 345 level. We're looking at CRM, and what you can see is we're definitely not above the 340. In fact, it's gone completely south on us there. So question from Mighty Mouse is, can we roll that? We could roll that. Why would we roll it? We'd roll it if we were bullish on this, right? At this point, I'm not thinking real bullish on this, and therefore I'm just going to cut our losses on this, and I'm going to get out of this trade here. I'm going to cut our loss. Now, you may be saying, Brent, we've lost most of what we can lose on this. What's the point? Well, remember, short options can be assigned early. The more they're in the money, the more they're likely to be assigned early. I don't want to even go through that. We've got 10 days to go, or 9 days to go till expiration. Sometimes you just take your licks, so to speak. You just get out there and you get out, okay? So here's what I'm going to do. I'm going to right click on this. I'm going to create that closing order, and I'm going to look to get out. Now, I'm going to confirm and send this. Now, there's my mid price, probably less likely to get filled at that mid price. So let's see if we can just put that in, and we're going to get there. Okay. So there, we're out of that. Okay. Question in the chat. Should we do these trades? Mike, now keep in mind, these trades are not recommendations, but I do encourage you to trade these on paper money, to just kind of try out, or do other trades on paper money to test out the platform, to increase your knowledge of the platform and to increase your knowledge of the strategies. But these are not recommendations here to trade. So that's CRM. That's an example of, you know what, when things are going bad, sometimes you just cut your losses. We don't want to risk that early assignment, and we'll take our loss. Hopefully those are limited losses there. Let's look at General Motors here, because General Motors, we're up a little bit. We're doing okay on this trade. It's a 50-51 short call vertical. In other words, we're bearish on this. We want the stock to stay below 50. Stock's at 47 right now. Okay. And let's look at GM. How about, okay? Let's look at GM. So here's GM. Generally, what would you say? Bearish or bullish? I'd say generally more bearish on this. Seems to be going down. Remember, with trades, you need to think of exiting in terms of 3 scenarios at least. 1, if it's going well. 2, if it's going poorly, if it's going against you. When are you going to get out? And 3, what if it's kind of just hanging in there? Then you'll probably have like a time exit. You'll probably get out some exit point regardless there. In this case, our time exit, we got 23 days to go. Generally on these trades, when we're at 10 days or less to go, we're going to look to exit these trades, okay? Even if they're doing good, bad, or just indifferent, we're probably looking to get out of a lot of these trades at that point. In terms of short verticals and long verticals as well for that, okay? And so here's what we go. This is what we're going to do. We're going to go, and I'm not going to get out because of the days till expiration, And because I'm still bearish on this trade, I'm going to let this run. Now, the other thing would be if we've made like 75%, 80% of what we can make, I'm going to get out. But in this case, look, we've made 45% on this. So I'm willing to stick with this. Okay. I'm willing to stick with this. We have some more meat on the bone, so to speak, we can still make on this just through time decay. So we're going to stick with GM. I'm not going to touch that. Okay. Let's go to the next batch here and let's talk about some long options. Okay. Here's some long options that we have here. This is a long put trade on AMD. We're doing okay on this. It's a trend trade. Okay. It is a trend trade as long as it is trending in our direction. In this case, the direction would be down. We're willing to stick with that trade. Let's look at AMD here and see what we got. Is it still trending down? I would say so. And so we're going to stick with that. Now, remember, if we're getting closer to expiration, okay, we still have more than 2 months to go till expiration. So no urgency to get out from that standpoint. We've made some money, but not that much. I mean, 5%. So it's not like we've made 50% on this trade, which at that point, maybe we'd consider getting out. So I'm just going to let that sit. And I've actually fairly recently moved the stop up on this there to help protect us on that in case it goes against us. So I'm not going to touch that one. Johnson & Johnson is one that's kind of indifferent. It's, mostly break even right now. It is mostly break even right now. And I've recently moved that stop up. Well, let's look at it. And so I don't need to move the stop again, but let's see what we got. I've got an exit if it goes below 152.50. Okay. That's right about here. So this most recent bounce, generally the trend's going up. Okay. Well, this is a bullish trade. Generally the trend's going up. We have a relatively tight stop and we have 23 days to go to expiration. I'm going to let that sit just a little bit longer there. Okay. Let's go to JP Morgan. Again, another just long call, plain old vanilla long call here. JP Morgan, it's doing well. This trade is doing well. We've got 37 days to. Now, if we start to see weakness in this, we may decide just to get out of this. We've made a nice profit. We may just decide to get out at that point. But at the very least, we probably want to make sure our stop is appropriate. In this case, I have an exit. It's not technically a stop. It's a conditional order to get out if the price of the underlying stock, JP Morgan, goes below 290, below 259. That's down here, 259. I'm going to jack that up a little bit. I'm going to say, look, we went up. We kind of got a bounce here. I'm going to say that's kind of my new support level. If we break below that, and I'll go about 1%, so below that or so. So I'll go about to that moving average and put a stop there around 267 or so and to get us out. So what I'm going to do here is I'm going to adjust this stop. I can right click on this. I can cancel and replace that order. Now here's my order right now. It's a conditional order where I'm going to go to that gear. And before I do that, I already forgot where I said, we said about 267. Okay. Let me do that again. 267. So I'm going to go to my gear and click on it and it brings it up in a different page. So let me just bring that over. Okay. And we said 267. So I want to say if JP Morgan marks above 292 or less than 267, right now it's 259. I want to adjust that. So I'm going to say 267 just to try and help. If it does reverse on us, I don't want to lose those gains that we've had there. So I'm going to save that. I'm going to confirm and send. I'm going to send that. And now when we look at this, it should give us that 267 mark. Indeed, it does. Okay. So let's move forward. We've adjusted that one up. This one, United Health is, let's see, this is a long call, 37 days to go. And we've recently adjusted a stop on here. It's doing okay. And Visa is a leaps call. This is long-term, this leaps call. Okay. So 491 days till expiration. As long as we're bullish on this trade, now you may use fundamental analysis, you may use technical analysis, you can stick with this. On this particular trade, I do have a stop based on the option price. It's about a $47 stop. Well, that's great because initially we entered the trade at $50 and our stop was around 35, I think, about $35 when we got up. So we moved that stop up. And so if we're going to keep that stop around 70%, let's see, what's 70% of 73? 73 times 0.7 gives me about a $51 stop. What did we say we have? We have about 46. We could, we can go either. We can move that up to 51 if we want. I'm going to cancel and replace that stop order, and I'm going to make that 51. Now, some of you are wondering, how does Brent get that days till expiration field? That's just a field that you can add on each of these columns are customizable, everybody. Each of these so if there's any columns that you want to add, maybe you don't have trade price on there, you want to add that, you can do that. Go to the gear, and when you click on that gear, it brings this up and it gives you the choices of things. And one of them says days. Go to the D's, there's days there somewhere. Why is days not there? Where's days? It's there. There's days, okay? So that's days till expiration. All right, and then you just can double click on it or click on it and click on add, and that'll then add to your columns there. So make sure you got that, okay? If you want to add that, but I think for options trading, it's probably a good call. Two columns I would probably recommend for all options traders. Well, for all traders, I would say the initial trade price. I don't think that's a default on there unless they've changed it. It used to not be a default, which I think should be, but add that on there. And if you're an options trader, days till expiration is an important one. If you're not an options trader, then it doesn't do you any good. So wouldn't help you out at all on that. Okay, let's move on down the list here. Because long verticals all we have in long verticals are the two we just added. Okay, so I'm gonna hold off on those. Here's one I wanted to show you today, though. This is what is this? This is a calendar spread. Different expiration months, same strike. Okay, different expiration months, same strike. So where do we want the stock to go? We want the stock to go to about 20 bucks would be our target on that. And you can see that, by the way, if you went to analyze Intel, and you can see that our peak profit would occur at $21. But there's a challenge to that. Right now, the stock is right here. Okay, so we're still doing okay. May even be making a buck or two on this. I don't know. But we're kind of in a little bit of danger here on this. Now, one choice I could do is I could just get out. Okay, I could say, look, let's look at Intel here for a sec. Our assumption is we're going to stay in this channel. There's our support. There's our resistance. We're right there. I wouldn't say that's a definitive break at this point, but we're kind of flirting with it, aren't we? So we could just say, well, look, we've done okay with this trade overall. Maybe we've paid our commission or something. I don't know. But we could look to get out of this trade and just kind of not take the risk on that. And that's certainly a viable thing. But I want to show you, how to possibly manage this. One choice is we can roll this and bring in a credit if we like. We could roll this trade and bring in a credit. So we have a 21st February expiration. That's expiring in 9 days. We have an April 17th expiration. That's our long contract. What we could do is we could look to take that. So right now we have April and we have February. This is short. This is long. If we go ahead and do a trade where we buy back this February, we buy that back and we sell a March, then the net result is we've kind of moved this February out to March. Now, that's what we call rolling. Okay, that's what we call rolling. The challenge is that rolling can be deceptive. It's like this miraculous thing where, no, the reality is rolling is just, we're buying back the February and selling a March, but we can do it in one order ticket. But there still is multiple commissions involved in that. So it doesn't necessarily save you commissions, but it can be convenient in that regard. Okay. So what I'm going to look to do is I want to consider rolling this out into March and see what that gives us. So I'm going to right click on the one I want to roll. I'm going to right click on the one I want to roll, and I'm going to go to create rolling order, and it's going to say sell calendar. Basically, that's just because it's taking this and it doesn't know about the previous trade. This order ticket right here is essentially a calendar order ticket. And I'm going to go I'll go to the 21st of March here. So if we were to do that, we could roll this out to we could bring in about roughly $55. It's a moving target, okay? This price is changing on me. But we can bring in that credit. And then what we would be left with is the March contract and the April contract, which you can't see on this screen. So that's a possibility on that. Now let's do this. I want to analyze this before I do this trade because I want to give you another possibility here on this. Here's what this order would look like. This is our existing order right here. If we were to do this trade, I'm going to move this up just so you can see it a little bit better here. This gets a little bit complex here. So if this is new to you, it's okay. It's okay. But look, this is the existing trade. This long February contract is going to cancel out this short February contract. That would be gone. This would be gone. And what would we be left with? Here we go. We'd be left with this. All right. And so let me get rid of my little doodling. That's what the net result would look kind of like this. This is still the stock's up here, and we still have this kind of challenge in that we're still up in this area that's a little bit more of a concern, right? We're kind of flirting with this area up here where we start to get into losing ground. So let me give you one other possibility here. And the other possibility is this. The other possibility is I could roll this not just out in time, but I could roll this up to a 21 call. Now, if I do that, it's actually not a credit we're bringing in, not that $55 credit. It's actually going to cost us a little bit. Not including commissions, it's going to cost us $5. Well, $5 isn't the end of the world here. And I know there's some traders out there that will say, I'm never going to roll for a debit. I'm not in that camp. I think sometimes you can roll for a debit. And so, because what that would do is, now look what happens if this stock goes up in this range. it actually helps protect us up here. Now, if the stock goes down, then if it reverts back down, then we're back in trouble there, right? Originally, our target was to go to $20. So you have to kind of decide, well, do I think this is going to come back down or not? If I think it's going to come back down to that 20 level, then just rolling straight out would make total sense. If I think it's going to stay up in this level, then you can diagonalize it there. All right. And in that case, you would do in that case, you would roll to that 21 instead of the 20. All right. All right. So let me go and do that. All right. So if I roll this, one thing that happens, let me just send this here. I'm going to send this trade. And actually, let me make sure this fills because I want to show you. Let me confirm and send that. So that's going to bring in $54 credit. But that isn't necessarily a profit, so to speak. That's a credit, because if we look at our orders on Intel, let me go to, not that, let me go to account statement. Let me go to Intel. And let's look at our trade history on this. Okay, so Intel, we originally sold this for 75 cents. We originally sold this for 75 cents. We bought it back for 198, but we sold a new one for 254. Okay? So there's multiple trades going on here at this case. But here's my point. My only point is this. Just because I brought in a credit, and that's nice because that goes immediately in my cash balance. Just because I brought in that credit doesn't mean this trade, it changes the risk on this trade. I still have that same risk. I still have that same risk there. Okay. All right, let me just get to, let's go questions here. Is there a reason you wouldn't just roll up and over the short call instead of rolling both? Now, just to be clear, Bridget, I did not roll both. I just rolled the short call here. That long call remained untouched. The long call was this April. I didn't touch that one today. I just took that February, bought it back, and sold the new March call. Now, another choice you could do, and I don't want to get too far down the rabbit hole here. We could just get out of the short call and just leave ourselves with this, which is just a long call, which just totally changes the trade. The calendar is more of a neutral trade. If I just left the long call, then I would turn it into just an outright bullish trade here on that. So I've also kind of kicked the can down the road. We have 9 days till expiration. I had 9 days till expiration. Now I've got 37 days till expiration. So we'll look to roll that again there. Okay. Let me just double check time. Okay, we're getting a little low on time, but let's see what we got. Can I review the cost and the profit goals for the pre and okay? So I'm extending the trade out. In terms of profit goals here, my profit goals I think are best visualized by going to the Analyze tab on this and seeing. Just make sure I don't have any. Let me get rid of one quick sec here. Let me get rid of this now, because this is now the new trade I have in there. You can see where our profit is. Now, our max profit is around $130 on this new trade at this point. But the reality is, we're not going to hold out for $130 necessarily on this. So as we get closer to expiration, we're going to look to get out, especially as that long contract gets closer to expiration. We still have got 64 days. One reason we did this trade out 64 days in the first place was to give us the opportunity to roll. Okay, that gives us that opportunity to roll. Because if you just do the long contract out, say 3 weeks or something like that, really there's no opportunities you have on an intermediate basis to roll that trade there. Okay, so in terms of loss, as long as that trade stays neutral. Right now, I kind of have this neutral trade. I'm assuming it's going to bounce down. But if we break above here, I'm probably going to look to get out. I'm assuming this neutral trade, I'm going to just have an exit, and I'm going to say, look, if this gets out, we'll say if it goes above 23 or 22 and a half, then at that point, we've broken out of our channel definitively, and we're going to get out of that trade. That's where I would look to manage in terms there. One thing with calendar spreads is they tend to make money slowly. They tend to lose money slowly. I say tend to. Yes, they can go to a max loss immediately, but generally within normal movements of the stock, even if it's going against you a little bit, you don't realize anything near a max loss if you have quite a few days to go to expiration. Of course, that's a generalization, and I can't tell you what you're going to gain or lose on those, but you just need to be careful on that. That's why I don't necessarily, that's why I'm more likely to get out based on the stock price breaking out of our technical forecast versus just like a loss amount based on the option there. Okay. There. George said, Brent, on the analyze, I need to update the March date. Was that not showing? It should show. Yeah, there's my March date, George, and there's my April. This is the one we got out of here. By the way, on this Analyze tab, when it comes in this kind of black color, that means it's a trade that's in. Whereas if you have a simulated trade, let me just throw in a simulated trade here. Oops, wrong thing. Oh, I see what you're saying. Okay. If you throw in a simulated trade, it's colored there. All right. If you are doing the Analyze tab, and I don't have time to get in the whole Analyze tab, what George was saying is you got to update your dates up here when you start looking at your profit loss. That is my bad on that because my March date was March 21st. So therefore I would go to March. There. And that'll give me more accurate representations on those. So, yep, very, very good there, George. Thanks for pointing that out. All right, everybody, let's take a look here. Let's just kind of recap what we did. We talked about long call verticals and long put verticals. We talked about reward and risk on those and where the strike prices you choose determines your potential reward and your risk on that. We gave you examples of a long call vertical and an example of a long put vertical with varying reward type risk trade-offs on those. We also talked about managing options. We talked about managing short verticals, and we talked about Mike for helping me out in the chat, of course. And coming up next, Mike for helping me out in the chat, of course. And coming up next, we have, what do we have next? We have trading price patterns. Make sure you check that out and make sure you subscribe to the Trader Talk Schwab channel. Have a great day, everybody. Bye-bye.